Okay, everybody, welcome to this webinar by Cambridge Finance. Today, we're going to talk about Excel techniques for sensitivity and scenario analysis. It's going to be a 30-minute practical webinar for finance and financial modeling professionals. And the main reason for these webinars is to show you how Excel and real estate finance come together in practice for real estate assets underwriting and analysis. Okay, so let me go through some of the theory first. I always like to talk about what I'm going to talk about, but the main idea here is to first welcome you to this webinar. And Cambridge Finance, we really want you to skill up and understand what is going on in the world of Excel and the world of real estate finance. And then today, with the sensitivity analysis, sensitivity is the what if analysis. What happens if the variables that we are looking at on the underwriting side, what happens if there's a range of outcomes. So how do we stress test those in the financial models in Excel? So the main point that we want to stress today is how to identify key variables, how to deal with Excel data tables, and how these Excel data tables work in financial models, and it gives financial more robustness, and it's very important that we have a very transparent and reliable model. So we need model clarity. So these are the main areas where sensitivity analysis is great for. The main problem with financial models is that sometimes financial models are used as black box. Sometimes the formulas are hidden, sometimes or it's just so complex that you don't understand what's going on. So in our courses, we try to make you understand how a very elegant, how a robust financial model works, and how we can use Excel to really address those problems of clarity and transparency. So when we do a financial model, and I'm going to show you a financial model that we use, we pretty much look at we start with our base case. So what we think the yield's going to be, what do you think the rents are going to be, what do you think the construction costs are going to be? And this is just one static model. But the idea with sensitivity analysis is that we need to stress what happens if the yield is not 5%, is 6%, and so on and so forth. So what we do then is we create our underwriting model. So we say, okay, the yield's going to be 5%, the rent's going to be 100, the construction cost is going to be 200 pounds or 200 euros per square foot, or 2,000 pounds per square meters. And then we, in this sense, so that we create built-in automation tools that can deal with different inputs. And this is very important for when we do underwriting of real estate investments day in, day out. Okay. So the isolating of key variables, the 10% rule. So what I want to understand here when we do the sensitivity analysis is that when we are doing the what if analysis, we want to see which variables have the most impact on the return. So these are the areas that we want to focus. So what happens if the rent goes up by 10%? What happens if the cap rate goes up by 10% or cap by 10%? And then if you shift those in a systematic way, then you can see which variables will have the most impact. From our knowledge, from our experience, of course, we know the variables that will have the most impact, but we don't know the magnitude of difference. So in our experience, of course, is going to be the yields, right? So if the yields move by 10%, this impact will have a huge impact. But what I want to show you here is that the 10% is not an absolute 10%. The yield's not going to go from 5% to 15%, but it's 10% of the 5%. So it's 50 basis points. Okay. And then because then you can compare what happens if the rent goes up by 10%, but it's not the whole 10%. Is what happens if you go from 100 to 110. What happens if you go from 110 to 121? So that's the compounding effect of the 10%. So what does it have? What kind of impact it has on your financial models? And the same thing we can do for any variables, any variables that are inputs in your model. This can be stress test. Okay. And the most important thing is that when we're doing the stress testing, we need to look, because then when we're doing to the asset management, when we're doing to the decision of buy and sell, we need to make sure that we focus on the important areas that will have the most impact. Because sometimes we say, oh, but the rent or the OPEX might have an impact. Maybe it's going to go up or maybe it's going to go down. And then we kind of like, okay, we need to focus on the areas that we have more control and the areas that will have the most impact on our returns. Okay. And as I say, we always need to look at on the IRR basis, because the IRR is the one that gives us a return that is also in line with, like the general capital market return. So then you can check with fixed income, you can check with the stock markets, and then this comes on an annual basis, because a lot of times people look at the profit on cost or equity multiples, but then this equity multiples or profit on cost, they don't take into consideration the time that it's incurred in the project. So it might be that a project they'll have a profit on cost of 2 times, but then it's for 10 years. That is very different than an equity multiple of 1.2, but then it's for like say 1 year. So that's the thing that we need to be mindful when we are analyzing investments. Okay. Right. So we're going to look at the sensitivity analysis. We're going to look at one way data tables, one variable data table, and how do you do this in Excel? Okay, so we're going to stress test the yields and see how it works. Okay, and then we're also going to do the two-way or two variable data tables, and then also look at conditional formatting. So how it's going to be looking at from a color coding perspective, and then the key takeaways and next steps as well. And then we're also going to look at the scenario analysis. Okay, so let me just bring my model here. Okay, so this is my basic, development model that we created. So we're gonna see here that this is my time scale. So when we have the phases of our development. So we're gonna go from planning, construction. We're gonna have a lease up period. We're gonna have a destabilization operation period, and then we're gonna have an exit. Okay, so this is a scenario here. And then the total is going to be 17 quarters, so around 4 years and a quarter. And we have here the valuation. Okay, so that's the important part here. So in development, what we're going to sell. So here we calculate the GDV, we calculate the NDV, and then we calculate here the sales proceeds. So when we are doing development, we know that the GDV, what you're going to sell for, is really important when we do the whole valuation, because this is our investment bet as such. So this is what we're going to make money from. So we're going to buy a site that is under managed or under developed, or is just land, and then we're going to create something much bigger, something better, more efficient. Okay, so and there is no income in between. So that's why development is quite a risky investment, because you don't receive any income, and then it's just money going out, and then all your returns are going to come from what is going to be the gross development value at the end. So we need to look here at what we're going to sell for. Okay, so in this scenario here, it looks like we have a mixed use asset. So we have some office, retail, and residential, okay? And then from the GDVs here, we can see that the split of the assets. So we have 25 million that comes from the office side, then we have a 16 million that is going to come from the retail side, and then 18 million that is going to be residential. So we know that this development here is very much resi-led development, okay? And then we have here the GDV, and then we have here the NDV. So we need to understand what's the difference between GDV and NDV. And then also we need to understand what is going to be any discounts, but we don't call it discounts, but we call it like concessions that we might be producing when we sell the asset. So it might be in form of rent-free, it can be like in the form of CapEx contributions. It might be that you want to assume some rent, some vacancy, a top up, anything that might be part of our underwriting process, what we need to discount at the end. And then also might have sales costs of the agents as well. We might need to be factoring this in as well. And then we have here a total concessions and sale costs, and then it goes to 107 mil. So it's important for us to really understand what's the difference between the GDV and the sales proceeds, because you see here there's a leakage of around 14 million, okay, that we need to understand where this leakage is coming from. And then we have here, once we understand what the revenue side is, which is our valuation, and then we can look at the outlays here. So how much we're going to spend for purchasing the land, how much we're going to spend on building the site, the hard costs and the soft costs as well. And then the financing costs that will be taken into consideration here. So we have in this model here, we have both mezzanine and senior debt. So we calculate here from a cash flow perspective, the senior and the mezzanine. Okay, so this gives us around 12 million of finance costs. And then we have here the total costs, including finance. And then here we have our cash flows. Okay, so this is going to be our base scenario. And here with our cash flow here in quarter, okay? And then also the construction costs are distributed using what we call an S curve, okay? So a normal distribution using the S curve. So this is my cash flow here. So my cash flow, we have the development cash flow, money going out, and then the development cash flow here, which is all the negatives, because that's the nature of development, money going out. And then there's a period here of stabilization, rent-free, and then we consider, and then we sell here in period 17. Okay, so that's our model here. This is on an ungeared basis. On a geared basis here, we do calculate the split here between equity and debt. And then this is a joint venture scenario as well, that you have developers equity and investor equity, the GPLP split. And we also have two types of debt, senior and mezzanine. You can assume that it's the senior and the mezz is one, so it's a whole loan. But in this case, I made it a split. And then also here we have a model that is assuming that the equity needs to be spent first. So it's an equity first model, which is normal the case in development, that the equity needs to be upfront. And then here is the money that you're going to raise from the equity side, from the developer's equity. And then we have here a senior debt of 32 million and the mezzanine debt of 20 million. Okay, so this is my model here. So on the geared side, what we have here is the geared cash flow here. So my equity contribution is going to be 10 million and 2 million. So that's coming from myself if I'm the developer, and the LP, so the investor here. So in total, we're going to be spending 12 million in equity, and then we receive nothing, because it's all funded by the debt, by senior and the mezzanine, nothing. And then at the end, we're going to receive the profit share. So 44 million is what we have left to distribute after we pay the senior and the mezzanine. Okay, so this is the basic cash flow, the development cash flow that we are using. And then if you assume that you know exactly what's going to happen in the world, then your returns are going to be as such. So we have here ungeared returns, geared returns, the developer return, and investor return. So the developer might be the GP, and then the investor might be the LP in a private equity scenario. Okay. And then we calculate here the normal KPI, so profit on cost, equity required. So then the difference between the equity required ungeared and the equity geared is that we have 80% gearing. So therefore, the difference here, we're going to spend only 12 million in the equity, and then the rest is going to be funded by the senior and the mezzanine. And then we have here the equity multiple as well. I don't know if you can see here. Then we have the equity multiple here, which is 1.6 times on an ungeared basis, and then 3.5 times. So I'm going to treble the money and a little bit on the geared basis. Okay. And then here we calculate the IRR, and then what is important here, we also calculate the residual end value based on our target IRRs. Okay, so the site is for acquisition there at 10 million, but if we have a target IRR for the development on the geared basis, that means that you could be paying 6 million more, so 16 million, and then the 16 million is going to be the 16 million is going to be giving an IRR of 25%. Okay, so I hope that's okay here. Okay, so if you believe you are 100% correct on your assumptions, then that's the end of your underwriting process. You're going to make 34.2% in IRR. Your net present value is going to be 4.4 million, and the maximum you could be paying here is 16.5 million. So the 16.5 million is coming by targeting a 20% IRR. So I'm just going to show you here how this is done. Okay, so if you pay here 16 million as your, I hope this works here, as your lend. So as your lend value here, so if you pay here 16 million for the lend cost, then your IRR should be 25%. So that's my residual end value. So that's how I calculate the residual end value here based on the target IRR of 25%. Okay, so if you think everything is correct, you are 100% sure of what's going to happen in the future, then it's the end of the underwriting process. But the reality is we don't know. Our crystal ball is pretty good, but not as perfect as we think it's going to be. So we need to stress test some scenarios. So that's actually the meaning of this session here, to show you how sensitivity analysis works. So when I mentioned, so I'm going to do here the sensitivity, the stress testing here. And then when we say, okay, we need to identify the key variables. So the main variable here, you can look here, is going to say, okay, the main variable here is the one that relates to the residential side of this development. So it's what is giving rise to this 80 million, because 80 million is around 70% of the GDV. Okay, and then the most important part here is this yield. So we have here a yield of 3%. And then what we want to do here is say, okay, what happens if it's not 3% in the future? Okay, so the idea of the 10% scenario, so I'm going to do here, I want to do here just with the use of percentage change. Everything is going to be really from scratch here, so you know how it's done when you go back to do it yourself. And then we're going to do here the resi yields. Okay, and then we're going to say, okay, what's going to happen with, let's look at the IRR. So which IRRs we're looking? They're looking at the ungeared IRR. I'm just going to link here with the on top. So it's going to be the ungeared, geared, developer. So I'm just going to look at the IRRs here. Okay. And then what we're going to do here is going to say, okay, I'm going to start here with my base case 0. Then I'm going to do here 0.9. So the 10% less and 0.8. Okay. And then we're going to do here 1.10. Oops, 1.10. And then we're going to say 1.20. Let's do it here. So my Brazil yield is going to be, the base case here is going to be 3%. Okay, so that's a 3%. And then also I left without formatting, so I know I'll show you how to do the formatting. So if you press Control Shift 5, Control 1, tap 2, then you're gonna get the formatting that you want. And then you can just say, okay, so it's gonna be 3, and then we're gonna do here the 3 times 1.10. Okay. And then we're gonna do here a 4 for a fixing, and then I'm gonna drag this down. Okay, so this is very basic. And then, oops. Then I'm just gonna copy here. Just want to show you how I do this from scratch, really. Okay, I could have put everything there, but I want to show. So what I'm showing you here is pretty much how everything. Yeah. And then just want to show you here what the formula looks like. So I'm doing formulas and show formulas. Yeah. And that's what I've done. Okay, so this is the formulas. Okay, so then I'm gonna say, okay, what is the ungeared IRR? So I'm gonna go here again, geared IRR is gonna be the 19.5%. And then I'm just gonna drag this to the right. So what is the geared IRR? Develop and invest. Okay, so I'm just really want to show you how it's, and then this is a percentage, so Control Shift 5 again, Control 1. I'm just gonna give it 1 decimal place. Okay, so ungeared in the base case is 19.5, geared is 34.2. The developer will get 50.1, and the investor is gonna get 30.6. So in this model, we also have the promote structure. So we're gonna have like a profit share that is more profitable for the developer given the target IRRs. So that's why there is a difference between IRRs for the developer and the investor. Okay, and then what we're gonna do here. So this is the yield. So what we're gonna do here is that we need to do what we call the data table. One thing I want to mention to you is that data tables, because here we have formulas, okay, because we have formulas in your, as a base case here, as your input scenarios. Data table doesn't like it. So what you need to do here is you need to copy this and paste as values, okay? So this is, I don't know if it's a glitch or not, but it doesn't work. So these numbers here can't be formulas. They have to be inputs. So you need to be careful when you're dealing with data tables that this here are absolute numbers, are not formulas linked to the percentage change, for example. So all we need to do here is now highlights the cells. Okay, so we need to highlight the whole table here. So where the outputs are. So it's the row here, and then they relate to the outputs here that we have above. So ungeared relates to the IRR above, and then the geared IRR, and then 50% relate to the developer's IRR, and so on and so forth. And now is the magic. So if without the data table, what would happen is that you have to create like a how many sheets? 1, 2, 3, 4, 5 sheets. Create one sheet with 3% Resi yields, create one with 3.3, create one with 6.6. So you don't want to do this. So Excel can help you with building this data table all at once. So all you need to do now is highlight where the inputs and the outputs are. So you need to highlight where the data table is going to appear. And then you're going to go data. And then this is where the magic is. So it's data, what if analysis data table. And then the data table here is going to, you see there is row input cell, column input cell. So what we're going to do here is just create a column input cell. So here, you know that your inputs are in columns. So what we're going to do here is say, okay, my row column input cell is going to be related to what? It's going to be related to my resi. So we need to link this and you're going to say, okay, my column inputs refer to the G29. And you go, okay. And then once you go, okay, then you can see here what's happening. So that's the data table for you. So it's we need to format again. So Control-Shift-5, Control-1, Tab, 1 decimal place, okay? And then this is what is going to, so you know that here is your base case. So Control-Shift-7 here for the, or in Control-B, say for the base case. So this is going to be your base case here. And then you're going to say, you know that your IRR on the base case is 19.5% and then 34.50. But then if you say, okay, a 10% increase on the yields is going to make your IRR drop by 2.5%. Yeah. And a 20% increase in the yields is going to make your IRR drop by 2.4%. Oh, this is not correct. This is 3.6. Or some, I was wondering like why it's the number here it's 1.2. So that's the problem. Okay, so this is what is going to, so a 20% increase on your yields is going to make your IRR drop by 2% on an ungeared basis and on and then 5% on a geared basis. And then you can analyze here what is the impact of a 10% increase in yield. So you know the yield goes up, returns go down. Yeah, yields go up, values go down. Your IRR will go down as well. Okay, so here you can look at the IRCS. And then you can also do conditional formatting. So normally people like to put the what we call the traffic light. So you can go here, conditional formatting here, and then you have color scales here. And then normally the green here is the good scenario. So yields going down, then values go up, and then the returns go up. So you have to do this on a line by line basis, okay? Because otherwise, with the color scale, Excel will think that everything here belongs to the same the same range as such, but they are ranges for different returns. So conditional formatting, color schemes, and so on and so forth. So this is the sensitivity analysis. And you can do this as well. I'm just going to copy it here and then put it here. And then instead of the resi yields, what we want to do here, for example, is say, okay, what is the next one? The office yield. So if we go here instead of resi yields, we're going to stress test here, office yields. Okay, and then I'm just going to link this with the IRRs. And then we can do the same thing. And then we can just go, okay, so now the difference is we don't want this to be, we're going to start at 4%. So we're going to go here, 4%, 4, and then we're going to multiply this by variables. Okay, And then, so you're going to go 10% of 4 is 4.4, and then 10% of the 20% of the 4 is 4.8%. And then we do the same situation here. Don't forget that you need to make this absolute numbers. So we always need to copy and paste. So then these are not formulas, these are absolute numbers. Otherwise, data tables don't work. And then we create the same situation here. Oh, sorry, did I do it wrong? There's one, two, there's one. I'm just doing like you will want to put like everything, but it's because I'm running out of time just leaving the labels out. But you're gonna go again, data, then what if analysis, data table. And now the column input cell is going to be the office yield. Okay. And there you go. And then you're going to find here what is the impact. And then what we like to do here is say you want to, so then this is the testing on the office yield. And then you're going to say, okay, which ones have the most impact? And for you to check of which ones have the most impact, then what I normally, visually, it might be more appealing for you. So what I do here is say, okay, I'm going to test, okay, what is the impact on the geared IRR of the 10% shift on the residential yields and the 10% shift on the office yield. So what I do here is I can create like a chart. So I highlight here the series that I want the chart from, and then I go insert, and then I can put here a chart. So let's say this chart here. It can be anything, but I'm just making it a little bit quicker. So this is going to be the chart on the resi yield. So that's, and then the IRRs. Okay. So resi versus resi yield versus IRR. Okay. And then of course you can change here the IRRs and then here the yields. And then you can do the same thing for the, let me just, I'm gonna copy. I think it might be easier to just do the same thing for the office and then insert and then the chart here, then make the chart here. Okay, so office yields versus IRR. And then this chart alone with the charts here, you can see that the resi yield, you're gonna give, there's more volatility in the returns. If the resi yield changes, then there is if the office yield changes. So you see this by the slope of the curve. Okay, so maybe if you change here to if you change here to instead of bar, say you want to line, maybe easier to see, right? Then batch time. The line, then you see here that the slope of the curve is steeper on the resi yield than it is on the office yield. So in this, comparing these two graphs, then you will see that the 10% impact on the resi yield is greater than the 10% impact on the office yield. Okay, so this is for you to say, okay, I'm more exposed to the residential side. Of course, this is a resi-led scheme. So then you can see, okay, you are more, more exposed to the yield shift in the resi. But it can be done for everything. So it can be done on the rent side. So if you want to compare the rent impact, it can be on construction cost as well. So the only thing we have to be mindful of is this variable really meaningful? So you can stress test all those variables and then compare them with each other and see where the slope is the steepest, and then where the slope is the steepest is the one that your returns are more exposed to these variables. Okay, so in this case, I've done this like in just one, like two simple graphs, but you can put like all the variables together in one graph. But then this is just way to present. But the analytical process is this, that you want to understand what is the sensitivity of your returns based on those inputs. Okay, so I hope I'm overrun here by 5 minutes. So I hope you enjoyed the session. Okay, so the idea here is really to show you how the sensitivity works. And then what I want to, actually, I'm just gonna keep showing my slides. And then the idea really is that you understand how data tables work, and also the sensitivity, how you analyze, how you pick variables for sensitivity, and how you compare with one another. Okay. So try to build your first data table, apply this 10% rule, and then always use reusable templates is better for you, because then you keep all your underwriting systematic. Okay. And if you have any questions, please do send us an email, give us a call, follow us on LinkedIn. And we run our courses on a regular basis as well. So if you'd like to join us, please do. And if you have any questions, just drop us a line. Okay. I hope it was helpful for you. Next sessions, we'll discuss more about sensitivity. We'll discuss, I think, one area that on the sensitivity side that I didn't speak about today was the scenario analysis as well. So what happens if you have more variables to stress? So maybe for the next session, we're going to talk about the two-way sensitivity as well, and the scenario analysis. Okay, so thank you so much for joining me, and I hope I'll see you again. Thank you very much.